Good morning, and thanks so much for tuning into the trade setup. I'm Neeraj Shah, and let's take stock of the global news flow and the global markets and the global setup first. So, the US 10-year bond yield has now come off to 4.82 from the recent highs of 5% odd. So, a bit of a respite out there. But Bitcoin is very hot, and cryptocurrency stocks have extended the rally as Bitcoin topped $35,000 yesterday, doubling for 2023. General Motors CFO says the company has withdrawn the 2023 guidance due to strike uncertainty. And this is important from a UAW perspective, also has implications for global suppliers worldwide, including Indian suppliers to the US automakers. So important to bring that. And the last 48 hours has seen China do some serious moves and some serious posturing around support to the economy, including the decision to raise fiscal deficit ratio to about 3.8% from 3%. Now, keep in mind, while we had a manic Monday in the Indian markets out there, but both Monday and Tuesday for the global markets were a lot more benign. Yesterday, too, the US stock markets had a day in the green, which is probably a good sign. And like I said in the global news flow as well, the yields are the biggest draw point, 4.81 currently, volatility at $19 index steady at that 102 marks, so no changes there. There's some other data around rates and inflation. I mean, Zimbabwe is an outlier really in what's happening there. But Australia inflation has been higher. Mexico has been lower. Hungary's cut base rate by 75 basis points, which was higher than the earlier estimated. So lots of developments out there. To talk about the global setup, I think we've got the perfect guest today, Steve Bryce of Standard Chartered, with us to talk about his thoughts on what all of this could mean for risk assets. Steve, 5%, a good morning, of course, to you, but 5% was a big talking point. We've had a sharp cool off there too. But geopolitics, yields, interest rates, is the setup negative for risk assets like equities?
I guess in the short term, our sense is that we could still see some positive gains to equity markets. I mean, we've been highlighting that there's been reduced market diversity when it comes to the bond markets, which means that bond yields are probably getting very close to a peak, and we're starting to see that play out. And given the positive bond equity correlation, that may well feed through into equity markets as well. That said, we're starting to see things in credit markets coming under pressure. So we don't think we're out of the woods when it comes to looking for a recession in the US. And so therefore, on a 6 to 12 month basis, we have a preference for high quality bonds over equities because we think they're going to be much more of a protective factor in people's portfolios, of course. And high yield obviously would be at risk as well. So yes, in the short term, we might see some uplift in equities. We've obviously got short term seasonality positive effects as well for equities. But we don't think this is the time to go overweight on a longer term time horizon.
So this short-term seasonality impact, Steve, to your mind, is for US equities at large, or do you reckon emerging market equities too could actually benefit from this seasonality impact?
Well, obviously, there's a decent correlation between US markets and other markets around the world, so that's a positive factor. I mean, obviously, the Indian stock market, if you look at the Sensex, we've broken below the August lows. But if you look at the Nifty, we're still just about hanging on to that. So hopefully that remains the case and we can build from here. I think the other thing that we're looking at, and we talk about market diversity in the bond market, we've also seen decline in market diversity in the FX markets as well, which again suggests that the dollar rally that we've seen in the past few months may be coming to an end. And obviously, we're starting to see some weakness in the dollar, even against emerging market currencies, including the Indian rupee. So that dollar weakness could be a big tailwind for EM equities again in the short term if that was to play out.
So potentially lower yields, potentially lower DXY, both of which could actually mean well for emerging markets. Yes, I hear you completely. Where within this emerging market or the Asia Pacific bucket, Steve, would you believe a seasonality impact plus the inherent nature of either earnings, valuations, or flows could play out the most? Are there some favorites within this bucket?
Well, I think from our perspective, we've become a lot more concerned about China. Now, that might seem a little bit concerned given the policy news that's come out in recent times, where we're starting to see signs that they're going to increase the budget deficit target and try to stimulate the economy, something they rarely do. So it is potentially a strong signal, although the quantum of the stimulus is relatively small. I think that's the way that markets, after the knee-jerk reaction, will probably take a bit of a wait-and-see approach. So our view is that we take a diversified allocation. If you were to ask me over the next 5 to 10 years, which markets would outperform, I think India would definitely be in that category, given the strong growth potential. Obviously, the headwind is still this valuations, but I think we're just going to have to live that India, trades at higher valuations because it's got greater opportunities and greater earnings momentum over the long term. So from that perspective, we definitely wouldn't be ignoring India at this stage.
Got it. Just one final question, Steve. There was a train of thought which said that if China were to give a large stimulus or indications that they want to now support the economy, global flows, which have hitherto deserted China in the last 4 or 5 months, could well make a move there because the valuations are certainly in favor. Now, the noise that has come out from China in the last 48 hours, or albeit the last 2-3 weeks, I heard you say that the stimulus is not very large from an amount perspective, but all of this noise, would you believe that could pull some of the other emerging market flows towards China, and therefore there could be a bit of a impact on other EMs, or not quite?
Obviously, I mean, you're talking effectively about peak pessimism in China and the risk that could attract a lot of money going to it. And I think that's what we thought at the end of last year, right? So when we saw that the COVID lockdown controls were being eradicated pretty much in one fell swoop, we suggested that Chinese equities were outperformed massively, and we thought that would be a 6 to 12 month story, and it ended up being a 2-3 month story. So is it possible that we'll see something again similar? Of course it is, right? And at one level you'll say, okay, that could drain liquidity from other markets into China, but I would argue that actually that would boost China, boost Asia, from a growth perspective, and make people just generally more optimistic on the Asian outlook, which would be positive in aggregate. So I think there will be both forces, but overall, I think a rising China ship is good for all boats around it.
Got it, Steve. We leave it at that. Thank you so much for taking the time out and being with us and giving us your thoughts, and have a great rest of the week ahead.
Thank you so much. Take care.
Well, that's the view, as important in a market view, that you can get from a global side, from Steve Bryce of Standard Chartered. And like I said, maybe the global markets are benign, but he certainly believes that seasonality impact plus some bit of a cool off in DXY, not necessarily just the yields, might actually augur well for risk assets like equities worldwide, including emerging markets equities as well. So what's the trade setup for the day? The other big respite for our markets, if you will, while Monday looked really scary, is that Monday's fall was accompanied with lower volumes and net FI buying. Now, you might argue that we know that large caps didn't crack as much as mid caps and small caps, and therefore can mid caps and small caps continue to panic? They well could. There could be some bit of HNA activity involved and retail activity involved in the sell-off that we saw on Monday. But let's wait and watch. If indeed the screen shows a semblance of sanity, then maybe that panic might not follow. Markets actually, to my mind, now seem to be in that fear zone from where supports are usually formed. Now, am I saying that the markets will bounce back from here? Well, today's screen notwithstanding, I'm not saying that. But maybe the market's correct about a couple of 100 points, maybe consolidate at these levels. But we are now seemingly in that zone from where things could actually potentially turn, maybe in a day, maybe in a week, maybe in a month, but around these levels, 100, 200, 300 points. And then unless something really changes, including crude prices or something, this might well be zones from where you should avoid taking very large leverage shorts, is my humble belief. Bottom of ideas, order of the day, including private banks from a long-term investment perspective. I've heard a bunch of people now tell me that this is the level from where private banks could actually be the investment grade idea from India. Do watch out. The valuations are very low relative to what they've done in the recent past, but you could argue they've been low for a while. But this is what the chatter that I'm picking up from a bunch of very smart investors. Flows, like I said, it was a positive day for flows on Monday. 252 crores of net buying from their FIs, DIs, 1,000 crores. So that's great. The stocks to watch list, not a very long one. It's Today is more a global day in nature, but I'll still bring up a few stocks that might matter. So Delta Corp, the Bombay High Court has directed the DGGST of Intelligence of Hyderabad not to pass orders in the alleged tax shortfall of 16,000 crores. In fact, the court has directed DGGST Intelligence to not pass any final orders on show cause notices without prior permission from the High Court. Remember, Delta Corp and its subsidiaries have gotten GST demands for shortfall of tax paid from GST Intelligence Hyderabad to the tune of 16,000 crores. So that's quite something. Could this be a shot in the arm for Delta Corp? May well be. Let's see if the stock reacts today. I reckon it could. PNB Housing was the one standout result performer, and I thought not just that the results were strong, but they've said that they expect 17 to 18% growth in retail book with disbursement growth of 22% in FY24. They say COB is peaked out and should decline from here on, and has guided for credit costs of 0.6% for FY24 and about 0.4% for FY25. So do watch out for PNB Housing. Could well be a stock that could do well today. Mahindra Logistics, on the other hand, no such luck. Not the best of results. Margins came off to 3.92, a net loss of 16 crores versus a profit of 12 crores. Very likely could react negatively. Torrent Pharma is mixed, really. Revenues up 16%, margins improved a bit, net profit up 23%, but the numbers were lower than some estimates. In the con call, the companies indicated that the mid to high single-digit price erosion continues in the base portfolio in the US generic segment. So that is also not great news. And I looked at the brokerages, 3 brokerage notes. One has increased the price target, one has stayed steady, one has actually given a negative view. Nomura, I think, has said that the results were well below their estimates, so don't quite know what the stock will do. Difficult to pencil it out there. I think the comment around price erosion in the US portfolio is a bit of a bummer. Lloyd's Metal, I thought, came out with a good set of numbers. Revenues up 61%, margins expand 220 points or thereabouts, quite meaningful, actually 300 basis points nearly, and PAT up 62% as well. So this was one standout performer at the mid-cap end of the market. And I know I'm giving you a slightly old note. I came out on 22nd, but it's important because you will hear JSW Energy today to take stock of what one of the brokerages, which tracks it very closely, says. They've raised the target price to 520. They said that the quarter 2 was above estimates, 33% driven by Mitra profitability and higher merchant sales. And they said that the improved visibility on 81% renewable energy capacity could be a big trigger. 700 megawatt merchant capacity commissioning could be a big trigger. And they've revised the target price to 520. So do watch out for this one. Just very quickly, tell you about things that are slated on BQ Prime today in terms of conversations. A full-blooded market conversation with a bunch of experts. So you've already heard Steve Bryce. You'll hear Manish Sonthalia, ICI of MK Investment Managers at 10 a.m. today, or 10:05 today, as the case may be. You will hear Ashish Dhawan, founder of Chris Capital and co-founder Ashoka University, at 9 a.m. Andrew Holland, CEO of Avendus Capital Public Market Alternate Strategies, at 9:25. So it's a packed first 1.5 hours as far as corporates go, as far as market voices go on BQ Prime. You also hear Prashant Jain, like I said, joined MD and CEO of JSW Energy after a fantastic set of numbers, or Kavinder Singh, MD and CEO of Mahindra Holidays, at 1 p.m. So you want to tune in for some of these as well. Thanks so much for tuning into the trade setup as usual. Have a great day ahead.